everyone, welcome. Thanks for tuning in. I'm Hersh Sayta. This is a very special conversation, very special chat on Morgan Stanley's views with regard to banks as well as the larger banking environment. I have with me the Morgan Stanley India banking analyst Sumeet Kariwala to talk to us about all of those trends, break them down, as well as talk about possible opportunities as well, if we can. Welcome, Sumit. Let me first start off by just asking you how you believe the environment is shaping up. We spoke a couple of months back. Talk us through what you believe has changed maybe in the last couple of months in terms of views.
Thanks, Hersh, for having me on the show. I think the banking sector outlook from a 1 to 2 year perspective is quite positive. Near term, obviously, we are seeing some headwinds. If I look at deposit growth, that remains muted. Banks are still raising deposit rates, so there'll be some pressure on margins. Note on the lending side, the loan mix shift towards unsecured has slowed a bit, which means that the loan yields are not going to improve significantly. Also, there are asset quality challenges in certain pockets like credit cards and MFI. I don't think so this is a big system issue, but there are some players and some segments where you're going to see some challenges. Over and above this, we should not forget some of the regulatory challenges that are going to come about. The RBI has put out the draft guidelines on tightening liquidity, and we should see the final guidelines come out sometime over the next 3-4 months. Also, the RBI had alluded that they'll put out the final guidelines on expected credit loss provisioning methodology, which will again put some capital pressure on the sector. So we're going to watch some of these things. We have recently cut earnings for the banking sector. So yes, near term some challenges, but from a 1 to 2 year perspective, I think so this sector should do quite well.
Okay. Now, I'll stick to the entire banking segment rather than talk about some specific pockets, and I'll come to the earnings cut because that's very interesting. But just with regard to lenders in general, they've underperformed the Nifty, right? Why, of course, is that so is a known fact with the kind of deposit growth pressure, etc. But do you expect an outperformance going forward? Is that something that one can expect?
Yeah. So if you look at the sector and if you go stock by stock, what you will see is that there are 4 or 5 banking stocks which have underperformed. The rest of the sector has done very well. You look at the entire state-owned bank pack, you look at some of the mid-sized banks, some of the large private banks. In fact, banks that went through an asset quality cycle during the past decade, they've actually done very well. Some of the banks which did well in the last decade, they have kind of struggled because they were trading at premium valuations, and the valuations have now converged. Over the next 2 or 3 years, we think some of these banks actually can do better. We have a very constructive view on the large private banks within the sector. And I think the sector, as the large private banks do well, the sector outperforms the Sensex.
And you've cut earnings estimates, is what you just told me. So, in which pocket of banking, PSU, private sector, large, medium, small, where exactly have you cut earnings the most? And on average, in each of these pockets, how much is the earnings cut looking like, just for viewer perspective?
Yeah, the median is more like 3 to 5%, and the earnings cut have been much larger in the mid-sized private banks, where we think the impact from tightened deposit rates, lower margins, and also the potential regulatory changes around LCR and ECL, all of these impacts could be higher. So the maximum impact has been in the mid-sized banking space. Also, some of these banks are more exposed to MFI and credit cards, and therefore the higher earnings cut. State-owned banks have been relatively okay. We do see some pressure on the NIMs, but the asset quality for them is doing fine. They have lower share of unsecured as well as MFI. Also, the corporate lending cycle continues to remain benign, and we have a decent recovery pipeline over the next 3-4 quarters. So yes, we've seen higher earnings cut for the mid-sized private banks, to answer your question.
And Sumit, in all of this, what the one piece that's really standing out outside of asset quality, possibly, which is, of course, in certain pockets, but the main piece here is going to be deposits, right? We are not seeing meaningful uptick with regard to deposit growth, and that's likely what is really dragging or pretty much carrying this entire conversation. When do you expect that to turn?
So the lead indicator for deposit growth in our view is inflation, and as inflation continues to moderate, we think deposit growth will accelerate. Obviously, there are a number of other factors related to government spending, government keeping money directly with RBI, which is not part of the banking system. The tightening of liquidity requirements, especially for non-retail deposits as per the LCR guidelines. All of these factors have weighed on deposit growth and actually will continue to weigh on deposit growth over the next few years. But we think deposit growth will accelerate despite all these factors as inflation continues to move lower.
Right, and do you believe financialization of savings, which is possibly a mega trend over at least this decade, seems to be, is what is also dragging deposit growth?
So the money remains in the banking system, whether you put the money as a retail deposit or you put that money in equities or mutual funds. The money is part of the banking system. Money doesn't move out unless you are, take for example, buying gold, etc., which is imported. So the money remains part of the banking system. What can happen to an extent is that the multiplier could get impacted, and we need to do some work over there. But if I look at the RBI data on ownership of deposits over the last 3 years, the share of retail deposits has gone down in the overall mix. Now, obviously, as part of the LCR regulations, banks need to maintain more liquidity on non-retail deposits. And to an extent, yes, there could be, over the medium term, some impact on money multiplier. But outside of that, just higher financialization of deposits, of savings should not be that big a factor.
Okay, and of course, then the other pillar of this is rate cuts. How quickly and when?
Yeah, so our economics team is not forecasting for any rate cut over our forecast horizon. If and when the rate cut happen, the first impact is negative on margins because the loan yields and the loan book will reprice faster than deposits. So there'll be a knee-jerk margin decline in the first quarter. Almost 40-50% of the loan book is linked to repo, and that will reprice within 1 to 3 months, depending on the bank. But obviously, over a 1-year period, deposit rates will catch up. Will deposit rates catch up fully? That is the big question. I think so. Retail deposit rate cut in the current cycle will lag, and the rate cut could be lower than that of repo. We'll have to wait and watch. But if you'll ask me, the more important factor, as in when we move towards rate cut, will be the growth outlook. As the RBI gets comfortable with more liquidity and deposit growth accelerates, I think so. What investors will be more comfortable about is the growth acceleration and the improved outlook for, say, fiscal 26 and 27, which will be a positive catalyst. So if you'd have asked me this question, say 1.5 years back, when we were not that worried about growth, I would have been slightly more worried about the rate cut from a 6-9 month perspective. Now, take for example, if we are moving towards rate cut, it's actually a positive for the sector.
Sumit, it's a great point you make. So even if rates were to come off, there's a likelihood that deposit rates may not get passed through fully. While floating loans, of course, will have to re-rate fairly quickly, deposit rates may not fully translate. How likely is that, in your opinion? Because that will definitely mean a margin shrink, which over the medium term, which will further accentuate the pain in the system.
No, that is correct. And actually, unlike say prior to 2019, when loan yields were not linked to repo, Indian banks didn't have that much of margin volatility. Now the margin volatility has gone up, and it'll be a function of how fast RBI would cut rates or increase rates. Take, for example, um, post-COVID, the repo rate went up by 250 basis points, and which is why the margins at Indian banks went up quite meaningfully. And as margins will move lower, you will see rates come down. That's a fact. And I think so. The net impact on margins will be negative because, take for example, the CASA deposits will not reprice lower. The important question and one of the factors that we take into account when we think about stocks is that which banks have retained the benefits from higher rates over the last 2, 3 years. And if you go bank by bank, what you will see is that there are certain banks where the margins are meaningfully higher than what it was at pre-COVID. And for those banks, even if they lose, say 10, 15 bips of margins as the rate cut cycle plays out, they'll still make ROAs which are better than pre-COVID. But that won't be the case for a lot of banks, and those banks obviously we are less constructive on. Uh, what we should not only focus on the extent of rate cut and therefore the margin decline, but we should also focus on who has a better starting point and who has retained the margin benefit as we went through a rate hike cycle over the past 2.5 years.
Right, and so Sumit, if I were to break this down, you like large private banks at this point. Some of the larger ones have done, some of them have done better on margins, as you correctly pointed out. But the largest one in particular, has a lot of margin pressure. Would you therefore likely believe that that particular bank or a clutch of other banks in the small and mid space may actually be not so great a bet at this point, given that there is no clarity on how the journey will work?
Harsh, I don't want to answer any question on a specific bank,
I
but
understand.
the way in which I'll put this is that there will be certain mid-sized private banks which will not be able to hold on to margins, and they may come down below pre-COVID levels. But understand a lot of mid-sized private banks have higher share of fixed rate loan book, and at the same time higher share of wholesale deposits. That those ALMs will do well when the rate cycle turns. So the answer is a mixed one. There are certain private banks which have a better starting point of margins. There are certain private banks which have a ALM which is more constructive from a rate cut perspective, and there'll be certain private banks which may not be able to hold on to margins in line with historical averages. So it's a mixed bag.
Right. Uh, Sumit, I'll shift focus. Corporate capex, right? We've spoken quite a lot about it, even in our last conversation. Uh, are we in a phase where Indian corporates are actually looking at bond markets, and therefore the banking system is seeing some bit of taper on growth because they are looking at bond markets? Is that a trend that you're actively seeing?
So we have seen disintermediation and the intensity change based on the interest rate cycle historically. And depending on where the interest rate cycle is, depending on how bond markets are developing, we'll see that mix move up and down. But I think the bank credit will remain an important funding driver. I don't think so. There'll be gradual disintermediation, but I don't think so that is going to happen very, very sharply. Yeah.
And Sumit, absolutely any concern with regard to asset quality cycle turning in your view, or not yet?
No, I think so. The asset quality cycle overall should remain benign over the next 2 years. Secured retail is doing well. Corporate cycle is looking very good, and actually we have not seen a lot of corporate loan growth. So where will the NPLs come from? There are pockets of unsecured and MFI where there is stress, but I don't think so. This is going to mean that the overall credit cost for the banking sector moves anywhere close to normalized levels. There'll be gradual move towards normalization, but I don't think so it'll exceed normalized levels in the next 4 to 6 quarters.
And therefore, would it be appropriate to say that ROA or profitability will largely be governed by margins and OPEX going into FY26?
So I think so ROAs will come off. There will be pressure on margins as we discussed earlier, which is not going to change. The rate cut is only going to accentuate that. And even without the rate cuts, I think so margins will continue to move lower. It may move at a slower pace. And once the rate cuts happen, there will be a knee-jerk reaction and then some pullback. But over the next 2 years, margins will be on a downward trajectory. Credit cost, they are very, very benign. So while I believe that credit cost doesn't exceed normalized levels, what you will see is that they will move towards normalized levels over the next 2 years. And if the ECL guidelines were to come into effect, the pace of normalization could be faster. So I'm not worried about asset quality overall for the banking sector, but you will see move towards normalization. And both of these will mean that the ROA will move lower. On operating leverage, there are certain banks which have invested aggressively, but I think so there are a lot of investment opportunities and banks will have to continue to invest in technology. So I'm not expecting significant operating leverage for the entire sector, but there'll be some banks which can do well.
Right. Last question with regard to you being bullish on larger private sector banks. Talk us through what factors you're looking at, because some of these banks haven't moved. So what are those factors? One, and two-pronged question. One, what are those factors which will help them move? What are those levers that you believe if the market starts to see some of these banks could deliver outperformance there? And second, why are you in general bullish? Give us maybe 3 or 4 reasons why private banks, larger ones, stand out versus some of the others.
Yeah, no, interesting question. So let me answer the first question on what will differentiate the large banks. See, when you look at the previous decade, 2010 to 20, the key driver of relative valuations was asset quality and balance sheet strength. There were some banks which did very well on asset quality and the rest of the banking system struggling. As I mentioned earlier, this cycle over the next 3-4 years, I don't think so any significant challenges on asset quality. There'll be a move towards normalization, but I don't think so. Lenders in aggregate are going down the quality curve. What was asset quality in the past cycle will be profitability in the current cycle. Over the last 2 years, we have seen very, very high competitive intensity in the banking sector, and some of the players who have not been very disciplined will see ROAs move down much faster in the current cycle as opposed to any general cycle that we see in banking. And generally, when I think about profitability for the sector, the profitability turns when we see an asset quality cycle coming. Okay, before that, the profitability is generally benign. In this cycle, we'll see profitability come under pressure much earlier. So any bank which can hold on to profitability will be much better placed, and what was asset quality in the previous cycle will be profitability in the current cycle. With respect to why large private banks, if I look at various metrics, if I look at starting point of margins, balance sheet strength, the potential impact of various regulatory changes that could happen, which could demand higher capital, higher provisioning, higher liquidity. We just think that the large private banks are in better shape. Also, this cycle is going to be a lot about economies of scale, especially as profitability comes under pressure, and cross-sell ecosystem banking is much more important, where I think large private banks have done decent progress. So those are some of the reasons why we prefer them over the mid-sized banks and the state-owned banks.
It's always very insightful speaking with you, breaking down these banking trends. Thanks so much, Sumeet, for doing this. I know I've overshot my time, so thank you for that. And of course, look forward to speaking to you very, very soon again to try and take a download on the latest.
Thanks, Harsh. It's my pleasure to be on the show. Thanks a lot.
Right, that's of course Sumeet Kariwala, Morgan Stanley, talking to us about all that's happening in banking. Of course, all the time we have on this one. From myself, everyone who puts the show together, thanks so much for watching.